Good day. I welcome you to the Abba Console platform once again. So today we are coming to learn cash flow statement. So accounting standards that govern recording of or preparation of cash flow statement is International Accounting Standard 7. That's IAS 7. Okay. So cash flow statement is basically about how organization account for cash that they receive during the accounting year and then the payment that they made during the accounting year. That's cash inflows and then cash outflow. So every organization have three main sources in which they generate cash and then in which they make expenses too. These are the components of cash flow statement or cash flow. That's operating activities, investing activities, and then financing activities. So we start with the meaning of operating activities. That's cash flow from operating activities. So when we say operating activities or cash flow from operating activities, it's about the principal activities of the organization. That's what we know the organization for. So, for example, let's take Supreme State Limited, for example. So, Supreme State Limited, they are the leading producer of bread in Ghana, and then they are producer of A1 bread. So, the main or the core principal activities of Supreme State Limited is production of bread. So any expenses that they incurred in the production of bread and then any revenue that they will generate from the sales of bread is termed as operating activities or the cash flow from operating activities. And then the next component is investing activities. So the example that I use, that's the Supreme State Limited, the company which produce A1 bread. Okay. After producing of the bread, it is their responsibility to send the bread to the final consumer or to supply the bread to their retailers and then the wholesalers or the shops and then the vendors which help them in the selling of bread. And they cannot do that without purchasing or buying of tricycles and then motor vans and other things. So the acquisition of the tricycles, motor van, and then vehicles to aid in the transportation of bread from their factory to their vendors or the final consumer is termed as investing activities. So the investing activities are just an enhancing activities. They are there to help the organization to achieve its own aim, or they are there to support the operating activities. And then sometimes too, the organization can decide to invest some of their money in other investment from like acquisition of shares in different company or purchase of government treasury bill. All these things are investing activities. And then the final component of cash flow statement is financing activities. So financing activities is about how the organization is able to finance it at operations. And then we have two main types of financing. That's equity financing and then debt financing. And then for equity financing, it's about issuance of shares. When the organization flows shares or issues shares to the general public for money, it's termed as equity financing. And then when it comes to debt financing, they occur in the form of loan, debentures, and then others. So in case the organization borrows money from the financial institutions or the individuals, it is termed as debt finance. So always, it's either the organization will use equity financing or debt financing. So anything that's way to financing of the organization will be captured or be recorded under financing activities. And then when it comes to investments, So when it comes to investment activity, that's any activity that will enhance the operating activities or the operation activities of the organization. And then any income that organization will receive from their investment will be recorded under invested activities. And then anything that's related to the core activities or the principal activities of the organization will also be captured under operating activities. So let's look at the format of cash flow statement. So the cash flow statement, as I explained earlier, it has been grouped into three segments. That's operating activities, investing activities, and then the financing activities. So we start with cash flow from operating activities. And we start with net profit before tax or profit before tax. For profit before tax, you can get the profit before tax from the income statement. Mostly the income statement will be given to you, and then the balance sheet statement will be given to you. So you get your net profit before tax from the income statement. And then sometimes too, in some situations, the net profit before tax will not be given to you. So it is up to you to do certain procedure to get your net profit before tax. And then we'll look at that later. After getting your profit before tax, you have your interest. That's if the organization paid any interest. And then after having your interest, you less your investment income. Don't forget that when you are preparing your trading profit and loss account, and then there is investment income, we add it to net gross profit as our other income. But for investment income, it's not part of the principal activities of the organization. That's the operating activities of the organization. So since investment income doesn't fall under operating activities of the organization, and then we have already added the investment income to our gross profit to arrive at net profit, it means that we have overstated our net profit, or we have overstated the amount that we receive from our operating activities. So in order for us to avoid that, we will less the investment income to get the actual operating profit in order for us to assess or measure the efficiency of the operating activities of the organization. But in case there's a loss on investment, it means if there is a loss on investment, the organization will treat it as expenses in the trading profit and loss account. So for that one, you add it right there. So after, when you get your profit before tax, you add your interest, and then you less your investment income, you arrive at operating profit. So after getting your operating profit, you write down for non-cash items. There are certain transactions that we recorded based on our assumptions. So according to previous concepts, accountant must anticipate losses but not profits. Because of this, accountants make provision for certain things like bad debt, and then for depreciation and then amortization of assets too is based on the company policies or the knowledge of the accountants that we use to make provision for all these things. So they term as non-cash items. So we adjust for all these non-cash items. First one is depreciation. And then for depreciating too, it doesn't involve any movement of cash. But in the preparation of the trading profit and loss accounts, we treat depreciation as an expense. And then when you treat depreciation as an expense, it means that it will reduce our net profit. That's indirectly means we have reduced our operating profit. So you add depreciation back to the net profit. And then amortization. Amortization is similar to depreciation. Depreciation is charged on tangible assets, and then amortization is charged on intangible assets. So for amortization, we treat this as an expense in the preparation of trading profit and loss account, which will reduce our operating profit. So we will add amortization to that to get the actual operating profit. And then for impairment, so for impairment occur when the carrying amount of the asset exceeds the recoverable amount of the asset. So for impairment, we will add it to the net profit or the gross operating profit to get the actual operating profits of the organization. Now when it comes to provisions, sometimes we make provision for bad debts. It is also in accordance with prudent concepts. So we are assuming that some of the debtors might not be able to settle the full amount that they are owing us. So we make provisions for them to which means that provision also doesn't involve movement of cash. If you make provision, you haven't received any money or you haven't made any payment. So it shouldn't affect changes in the operating profit or something like that. In the preparation of the trading profit and loss account, we treat provision as an expense, which will reduce our net profit or which will reduce our operating profit. So we will add it back to get the actual operating profit. And then profit and loss on disposal. So the example that I use in regards to Supreme State Limited, that's the producer of A1 bed. So sometimes the company can decide to sell one of its motor vehicles. And then when the organization sells its motor vehicles, the proceeds or the amount that the organization will get will be captured under investing activities. But we do calculation to see whether we have made profits on that particular asset or we have made losses. So the profit will be the difference between the cost at which that we bought the assets and then the total depreciation that we have charged on that particular asset plus the proceeds. That's the amount that we receive from the disposal of the asset. So let's assume that the cost of an asset is 100 cedis and then we have charged depreciation of 90 on the asset and then we sold the asset for 30 cedis. So it means that we the organization, we have enjoyed benefits of 90 and then we sold the assets for 130. So 90 plus 120, 90 plus 30 will give us 120. And then we bought the assets for 100 cedis. So it means the total benefit that we will receive from assets, it exceeds the cost. So it means we have made profit of 20. And then whenever organization make profit on disposal of assets, we add it to our gross profit, which overstates our operating profit. So you less it to get the actual operating profit. And then in case we sold the asset for 5 Ghana cedis. So it means we are getting 95 over here. And then the cost of the assets is 100. So it means that we incurred losses of 5 cedis on the asset. And then when the organization incur losses on disposal of assets, they treat it as part of its expenses, which will understate the operating profit. So whenever there is a loss on disposal of assets, we will add it back to the operating profits. So after doing the additions, we will get cash flow before changes in working capital. And then we know that the working capital is the difference between your current assets and then the current liabilities. So after getting your cash flow before changes in working capital, you proceed with changes in working capital. And then for changes in working capital, for current assets, whenever there is an increment in current assets, being inventory, trade receivables, or prepaid, anything that is current assets, you will less it. And then whenever there is a reduction in current assets, you will add. And then when it comes to current liabilities, whenever there's an increment in current liabilities, we will add, and then whenever there's a reduction in current liabilities, we will less. So increment in current liabilities is opposite to a reduction in the current assets, and vice versa. So after accounting for changes in working capital, you add it, you add the figures to cash flow before a changes in working capital. Then the figure that you get will be cash flow from operations. After getting your cash flow from operations, you less your interest paid, and then you less your tax liability or tax paid as well. When it comes to treatment of interest, for interest, you can decide to treat it under operating activities, or you can treat it under financial activities. So if you treat it under operating activities, it means you won't treat it again under financial activities. Now, when you treat it under financial activities, we won't treat it under operating activities. So after taking out your interest and then tax, you get net cash flow from operating activity, which means that this will be our total amount that we generated from our operating activity. So let's look at how we can calculate for depreciation. Sometimes for depreciation, the depreciation charge for the year will be given to you in the income statement or a trading profit and loss account. And then sometimes too, it won't be given to you straightforward. We will do certain adjustments before we will get the depreciation charge for the year. So in the balance sheet, we'll be given accumulated depreciation for the previous year and then accumulated depreciation for the new year. So let's use 2007 and then 2008 as an example. So let's assume that accumulated depreciation for 2007 is 1,500 and that of 2008 is 2,000. So if there is no disposal of assets, the difference between the two calculated depreciation figure will be the depreciation charge for the year. So if there is no depreciation, if there is no disposal of assets, you just find the difference between the two, which is 500, and then your charge for the year will be 500. But whenever there is a disposal, so when the organization sold any assets, it means that legally the organization is not the owner of the assets again. So everything that pertains or that relate to assets must be cancelled from our books. And then accumulated depreciation to is the summation of all the depreciation charge on all the assets. It means the asset that can be disposed of to, we have calculated depreciation on it as well. So yeah, we must find the total depreciation that we have calculated on the disposal of assets and less it from our accumulated depreciation. Sometimes too, the accumulated depreciation on the disposal of assets will be given to you. And then sometimes too, they will give you the cost and then the net book value. So if they give you the cost and then the net book value, we'll just find the difference between the cost and then the net book value to get the accumulated depreciation. Sometimes too, they will give you the person will state that maybe they sold the assets at a loss of this. So we can use the loss on the disposal of the assets and then the cost of the assets to calculate for the accumulated depreciation or the depreciation on the disposal of assets. So let's assume that one of the vehicles will dispose of for 300. So this is the accumulated depreciation for 2007, accumulated depreciation as at 2008, and then accumulated depreciation on the disposal of assets. We can use these three information to calculate for depreciation charge for the year. So this is our T account for accumulated depreciation. For accumulated depreciation, it has a credit balance. And then for depreciation itself, it has a debit balance. So there is a difference between accumulated depreciation and then depreciation itself. For depreciation as an expense, that's why we treat it as an expense or less it from our profits. And then for accumulated depreciation, it's as a credit balance. That's why when you prepare a balance sheet, you less accumulated depreciation from the asset to get to net value. So since accumulated depreciation has a credit balance, means the opening balance will be our balance go forward. And then we record it at the credit side, which is 1,500. And then the closing balance, which is 2,000, will be our balance go down 2,000. So the balance go down 2,000 will serve as we carry down at the debit side of the depreciation 2,000. And then since accumulated depreciation has a credit balance, whenever there is a depreciation charge for the year, means it will increase the accumulated depreciation. So we will add it or we record it on the credit side. And then whenever we dispose of an asset, since we are cancelled on the depreciation that we have calculated on the disposal of assets, it means it will reduce our accumulated depreciation. So we record the depreciation charge on the disposal of assets at the debit side of the accumulated depreciation. In conclusion, any transaction that will increase our accumulated depreciation we record at the credit side, and any transaction that will decrease accumulated depreciation we record at the debit side. So the total depreciation charge on disposal of vehicle, which is 300, we record at the debit side. So after recording this, the debit side will be 2,300, and that of credit side is 1,500. So we find the difference between the debit side and then the credit side, which will be 800. So the difference of 800 will be the charge for the year. So depreciation charge for the year, which is 800. So this is how you calculate for depreciation charge for the year. When you have been given accumulated depreciation for the beginning and for the end year, as well as the accumulated depreciation calculated on the or accumulated depreciation for disposal of vehicle. Okay. So after getting your net cash flow from operating activities, the next component is cash flow from investing activities. So for cash flow from investing activities, whenever organization acquire assets, or whenever the organization acquire non-current assets, they will pay cash, and then payments of cash will reduce the cash and cash equivalent. So acquisition of assets will invest, and then whenever the organization dispose of any vehicle or any assets, the proceeds, that's the amount that they receive from the disposal of the asset, would be recorded under investment activities. That's who add it. And then in case of the organization investing, or in case the organization have shares in another organization, and then at the end of the year, the organization declare dividends. So the dividend that the organization will receive from the other organization that would have invested in, that the dividend is to add, you record an investment activities for that one. So that is coming in, you add it. And then interest receipt. In case with the organization, you lend money to someone and then the person pay us any interest on it, you add that one. After that, you sum them up to get your net cash flow from investing activities. And then we proceed with cash flow from financing activities. So when an organization issues shares, the money that we get for the issuance of shares will increase our cash and cash equivalent. So we will add it. And then when an organization take loan on bonds or debenture from the public or from the individuals, it will increase our cash and cash equivalent as well. So and then when the organization pay dividends to its shareholders, money is going out, so you will less. And then for the treatment of interest, I said you can treat it under operating activities or financing activities. So in case you didn't treat it under operating activities, you will treat it under financing activities. since we are paying interest, money is going out, so it will be less. And then finance lease capital payments. So when the organization lease something, so for that one, at the end of the accounting year or for some period, you will be paying something to the lessor. After that, we will calculate for the total to get to net cash flow from financing activities. So after getting your net cash flow from financing activities, you want out of operating activities, investing activities, and financing activities to get your cash and changes in cash and cash equivalents. After getting your changes in cash and cash equivalents, we record the cash and cash equivalents at the start. So changes in cash and cash equivalents plus cash and cash equivalents at the start period will give you a cash and cash equivalents at the end. When it comes to changes in working capital, for although cash and bank, they are part of current assets. And then sometimes when there is an overdraft too is a current liability. But since you are calculating for cash and cash equivalents at the end, or changes in cash and cash equivalent, means we won't account for them, or we won't find the difference to determine that increase or reduction in either cash or bank overdraft, like the way we do for other current assets and then current liabilities. We are done with the explanation concerning the principles of cash flow statements. So we end today's sessions here. In the next session, we'll solve practical questions on cash flow statements. See you in our next session.